Well, aloha to all of you as the weekend progresses along here. We did end the week with a little bit of a problem. The markets and Tesla both took a little bit of a dive in the after hours trading. This is because Moody's, I mean, I'm assuming because all of the stocks joined Tesla in this downward move, so it wasn't Tesla specific. Moody's dropped the US debt rating by one notch. And that brought them into line with the other services who had made this decision years ago, quite frankly. And a lot of folks were asking, well, why is Moody's doing it now? Why didn't they do it earlier? Was there political ramifications to any of that? Anyway, I'm going to deal a little bit more with Moody's in a bit. I'm just right now trying to think of what will the impact be on Tesla for Monday? Well, first of all, Tesla was down $9. And as I mentioned, other stocks down about the same. Bond yields jumped up 3 basis points to, 4.48, I think. Getting very close to that 4.99, 4.98 area, which was the last barrier that it couldn't cross. Remember, it was at 5% a year ago and is down now as maxing out around 4.5 the last time that it made an attempt to go higher. I don't think it's going to go over 4 or 5. I think it actually this last time intraday it got slightly over 4 or 5 for a second. I don't think it's going to go there. But in general, I'll tell you why I don't think that's going to happen. So, the first question is we are in a new bull market. And I think there's an excellent risk on environment. We've got the greed market, the greed index is way up there. We've got the VIX coming down under around 17% right now. And then for Tesla, we've got awfully good catalysts coming into the next 6 weeks. We will have both the affordable car reveal, and we will have the robotaxi rollout. So those are pretty significant catalysts. I've been saying over and over again that the robotaxi rollout will be the most significant new product or service introduction in the history of the world. Other than that, not very big deal. You'd think that if you're having the most significant introduction of a new product in the history of the world, that there would be some FOMO around that. And the FOMO is in there. I'm promising you that out of the 340-ish that we are right now, out of that 340-ish, probably at least 100 points of that is folks that are betting on robotaxi, Optimus, the new affordable car, etc. They're looking at the future and they're convinced that these things are going to happen and therefore there's going to be an impact. Okay, so what is going to happen then? My optimistic side says that we will not have much of an impact from the Moody's decision by Monday morning. Now, there's a caveat to that. I'll go into that in a minute. One of the reasons I believe that, though, is that the only real information that we have over the weekend to look at is Bitcoin, and Bitcoin is down about $600, which is, pretty small for Bitcoin. So I'm thinking, no, it's not really going to have it's not going to be a big deal on Monday. I'll also talk about the Republicans needing to get serious about cutting the budget more. We'll talk about that in a second. Full stop, though. That is something they have to do, or eventually, I think the market may decide that if the Republican budget is truly going to be seeing continued $2 trillion deficits and a $2.5 trillion deficit in the future, that this is not good enough and that they need to go back to the drawing board. So that's not going to impact on Monday, but it could impact later. We might also hear something from the Republicans as they, through the bill back to committee, back to discussions within the committee on Friday, and they said they're going to work on it all weekend. They just have to get this thing done. So maybe we'll hear more about that on Sunday or on Monday. Of course, we got the news shows on Sunday. We're going to have to hear something fairly soon that looks a little more exciting, or I think we could risk the market not being happy. And Moody's will show that that's what's making them unhappy right now. As for Tesla, the Moody's cut suggests higher interest rates. But of course, there could be other levers that could be pulled by Trump or others to get those interest rate downs. And I think that, as I've talked about now for a week, I think that when Trump gets back from this, well, he's back from the trip now. Now that he's back from the trip, I think his focus is going to switch to this bond market. I think he's going to do everything humanly possible, our presidential position of power possible, to get these interest rates, these 10 years down. Number one, I think he will put pressure on his new friends all over the world, China, even Russia, all these Arabs that he just visited, Japan, Australia, the United Kingdom. It turns out right now is number one. They have passed China in terms of the country holding the most U.S. debt. United Kingdom, Europe, I don't care. Everybody, he's going to be putting the pressure on everybody to buy bonds. Okay, all these guys. That's where the real opportunity is. I think that's top of the list, and I think that's what he's going to do. Now, we may not hear about all that. Maybe we'll just see it taking place. Number two, he's going to put pressure on the wealthy in the United States to buy bonds. And maybe this is my idea. So Trump, if you're listening, if you use this, please say, hey, Randy suggested this. There's some pressure to possibly increase the rate on the wealthiest individuals by 1 or 1.5% on taxes. Maybe Trump could say, okay, look, if you guys come in here, and we'll be able to see who's buying these bonds. If we can see that you billionaires are buying up bonds, we'll be able to see that. If you do that, we could get, maybe you'll put a number on it. We could get this many bonds purchased, this many 10-year bonds purchased. Then we won't do the tax increase. What do you think? What do you think? Doesn't that sound Trumpian? Anyway, number three, he's going to appeal to patriotism for everybody. Again, maybe he won't, but I think that's what he's going to do. I think he's going to say to the public, he's going to say, look, you guys, yeah, great. Buy the equities, buy the equities, buy the equities. I've been telling you it's time to buy, but really right now the bonds are standing in the way of really getting to the golden age. So buy bonds so that as a patriotic thing to do to help the country get on the right path. It'll lower mortgage rates, it'll lower car loans, et cetera, buy bonds. Number four, I think that the Treasury will start to quantitatively ease, which means they'll be buying bonds. They're already not selling bonds, and they already are buying some bonds. I think they're going to buy more bonds. Number five, pressure, a lot of pressure, a huge amount of pressure on the Fed to cut rates in June. Now, that'll be the least important thing. Believe it or not, the Fed's decision to cut interest rates will have less of an effect on the 10-year bonds than anything else that I just listed. I think those other five those other four are the things that Trump will do. We'll see what happens. And there's probably things that I'm not thinking of. I'm sure there's a few other things he could figure out. Potentially, again, I should have that. Number six. It should be number one. He is going to put massive amounts of pressure on the Republicans. You haven't seen anything until you see the pressure that's going to be coming down on these Republicans to get the big, beautiful bill passed and get it passed with more cuts. He's not going to be at all happy with the amount of cuts that are in that big, beautiful bill. And he's going to be coming in there telling them they need more cuts. Anyway, even if I'm wrong about everything I just said, I think the Moody's issue will be a short-term kerfuffle. It may not even impact equities or bonds on Monday at all. The truth is that every country in the world benefits from a strong American economy and therefore will benefit from buying those bonds. And so I don't think it's going to slow them down, the fact that Moody's cut the rate, and no one, there isn't a human on the planet that seriously thinks the U.S. is going to default ever, much less in 30 years or 50 years or whatever. So Tesla might have another day off on Monday. It's possible. They've had quite a run up. I wouldn't be surprised of that, but barring other negative news, like, for instance, a bad number out of China on Monday night, I suspect Tesla's going to pass over 365 this week. This is the last technical barrier. I think there's according to Brian Wang, there's a kind of a soft technical, barrier around 440 or something. I think we'll just blast right through that one. So we can get past 365. We can close above 365 this week. It'll be 100%. All the FOMO can take over. We'll go back up to all-time high by the end of the month or early into June. Okay, this from Tesla's own account on X. It says here, please share with us how FSD supervised has become invaluable for you. Film a quick video while you're using FSD supervised, phone or camera must be mounted or held by a passenger, not by you. And then keep it under 60 seconds. Those are the only rules. And then send those in. I've already seen a few of these. One individual who had no hands was, driving his car. That I'm not sure that counted in the system, but I'm not 100% sure whether that's okay. But that was one. I think we also saw an elderly person. So all kinds of possibilities there. If you've got a story, if you think that they'd be interested in, go out and take yourself a quick film and send that in. Then we've got this from Sabotage, Sabatage, is the handle. It says, I can confirm that the driver attention NAG has been considerably loosened in the latest release. Thank you, Tesla. And he says, next stop, FSD unsupervised. So that NAG was a real NAG. And I'm so glad that it's been lessened. So this is Randy Kirk. Hit like, hit subscribe, hit notify. Please consider the possibility of joining Patreon or joining here on YouTube and contributing to the channel because, it's costs money to put this little program together, and it costs a lot of my time. And here I am on vacation, continuing to provide you with my updates. So you might consider on Patreon or on here on YouTube contributing to the channel. But even if all you do is in fact, if all you do is watch the show, that's a contribution. If you like, that's more. Hitting notify. Why do you hit notify? Because later on tonight, Brian White's going to be popping up. We got Brian White again in the morning, and then tomorrow night, we've got your regular programming where we do the Monday morning show on Sunday night and talk about all the stuff that's going to be happening in the coming week. The All In Podcast folks, they've got their pod, the All In Podcast pod, which is almost as popular as my pod. Okay, they claim that they have the most popular podcast in the world. I think that they're going to have to use a way of modifying that. The most popular podcast, including 4 guys who used to be Democrats, who are now Republicans, who also, anyway, the All In Podcast pod this week eviscerated, destroyed, ripped apart the Republican Congress for failing to do its job to get the deficit down. And then there was this from the Rasmussen report. Says, although fewer voters now have a negative view of how Congress is doing its job, it's really quite a bit up from when Biden was in charge. A majority agree with a Republican Congresswoman's criticism of the GOP majority on Capitol Hill. The latest Rasmussen report's national telephone and online survey finds that 33% of likely U.S. voters rate Congress's performance as good or excellent, and that's up from 15% 1 year and a little bit ago, March of 2024. 41% now think Congress is doing a poor job, and that is down from 59% last spring. But Georgia Rep. Marjorie Taylor Greene recently said Republicans in Congress are not delivering on the mandate given to them by the American people, and 61% of voters agree with that sentiment, according to Rasmussen, including 33% who strongly agree. 27% disagree from that quote from Representative Greene. So the Republican Congress needs to listen up. We don't get this shot. We don't get the shot again in 2 years. We could lose the Congress. We don't get the shot again in 4 years. Who knows? Somehow the Democrats could find somebody to lead them. Anyway, I know that sounds almost impossible at this point, but it's now. Now is the time, Congress. You need to do your job. Get in there, cut that budget a lot more than you've cut it already, and let's make everybody proud of you. Even Moody's, of course, we just talked about, chimed in, and here's what they said. See, I held this up for later. Still looking deeper. Oh, I'm sorry. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. We do not believe that material multi-year reductions in mandatory spending and deficits will result from the current fiscal proposals under consideration. That's what Moody said. So why do I think Moody's did this last Friday? Everybody's like, oh, why didn't they do it during Biden's administration? Why do they pick now? Or they just, they hate Trump and, they're trying to rain on his parade after all the big successes last week. I got to tell you something, Congress. all those big successes in the Middle East last week, the decision with regard to pharmaceuticals, all the deals with China, all of the tariff deals that are apparently on the table, and all of the things that people are talking about that Trump has done in his first 100+ days, none of it matters as much as getting this deficit down. So let's do it. Let's get it done. The Federal Reserve plans to reduce its agency headcount by 10% over the next couple of years. Well-fed chairman, I'm glad you're going to do that, but 10% is it? And over the next couple of years, come on, you could do better too. You're supposed to be the one that understands this stuff and gets it. How about 25% and now, this weekend? How about that? In a memo sent internally on Friday, Fed Chair Jerome Powell said that the central bank is looking to trim the headcount by 10% through attrition across the Federal Reserve System, including in the Washington, D.C. headquarters and the 12 reserve banks nationwide. He says, I have directed the leadership of the Federal Reserve here at the board and across the system to find incremental ways to consolidate functions where appropriate, modernize some business practices, and ensure that we are right-sized and able to meet our statutory mission, Powell said in the memo. So President Trump, I'm going to say to you, when Powell ends his term in May of next year, please find somebody who can come in there and rip that agency to shreds. Maybe if they had fewer people, fewer cooks in the kitchen, they'd be able to come up with better forecasting and better decision making. Because right now, with whatever it is, 2,000 PhDs or 400, I forget what the number is. It's really a lot. They ain't doing much. They're doing a horrible job. Market Watch had this to say: I think the recession looks, the odds should be the odds. Oh, risk. I think the risk of a recession looks considerably lower than it did a month ago. That's Bill Adams, chief economist of Commerce Bank. The future path of the economy, however, is by no means free of obstacles. Ongoing trade wars have not gone away, for one thing. Trump could change his mind, or the U.S. could fail to strike more economic-friendly deals with China and other countries. U.S. tariffs, as they stand, would also stay at the highest in decades, even after recent reductions. But that's the whole point. The whole point is this is a balancing act. We were at 3% or 2.5% overall for our tariffs. Now we're sitting, according to, I think is it this article or another article I said, if everything was just stopped today, it'd be around 17.5 or something like that. That's 6 times the revenue from tariffs, potentially. Maybe not, because some things may not continue to be imported. But if you get more income from the tariffs and other stuff gets onshored, that is what we're trying to accomplish. It says, what's more, it says, while the trade news is no doubt less awful, it's still far from reassuring. That was Douglas Porter, chief economist at BMO Capital Markets, rather. What's more, all the uncertainty spawned by the trade fights have made households and business hesitant to spend, hesitant to hire and invest. Confidence plunged in the past few months, and anxiety is unlikely to fade quickly. Well, it might. It might fade much more quickly than we think, because right now Rasmussen is also reporting right direction, wrong direction at 47% right direction, 47% wrong direction, which is the highest it has ever been. The result, by the way, and Trump's numbers are coming up not only on Rasmussen, but across the board on other reports as well. The result, economists expect U.S. growth to taper off sharply this year, even though the threat of recession has receded. The first quarter gave a glimpse, with the first quarterly decline in growth since 2022, without a nuance here that the decline had to do with front-running imports. Quote, while a recession is no longer our base case over the next 12 months due to the recent reduction in tariffs, the likelihood is increased that the U.S. economy will experience several quarters of sluggish growth, wrote 𝐄𝐦𝐚𝐲, U.S. economist at RSM, in a note to clients. Just how sluggish? I'm going to interrupt again. I think that we could have sluggish growth in the second quarter, and that would still be a Biden problem. We could be going into the third quarter with kind of the beginning might be a little sluggish. By the end of the third quarter, we're looking great. And by the fourth quarter, golden age. That's my theory. I'm sticking to it. With a 15% pop on the S&P for the year. Just how sluggish? A new survey of top Wall Street economists compiled by the Federal Reserve Bank of Philadelphia sees U.S. growth decelerating to the slowest clip in 16 years if the pandemic era is excluded. Okay, got to take that part out. Forecasters predict growth domestic product, the official scorecard of the U.S. economy, will expand at 1.4 rate for the entire year of 2025. That's down sharply from 2.4 estimate before the trade wars heated up. I just think they're going to be completely stupid, looking dumb. By contrast, the U.S. grew at a frothy 2.8% clip in 24 and 2.9 in 23, well above what's considered sustainable speed for the economy. Well, it could be sustainable if it's done by productivity and by an economy that's based on actual productive workers. But when this economy of the last 2 years was based on government spending, no, it's not sustainable. Slower economic growth, in turn, is likely to lead to rising unemployment, while a higher level of tariffs could stoke a bit more inflation, economists predict. A more fragile economy also leaves the U.S. with a heightened chance of recession, even after the recent tariff reductions. Economists see a 37% overall a 37% chance of a downturn in the next 12 months, compared to just a 15.4% chance the last time the Philadelphia Fed surveyed in the start of 2025, but it's way down from a couple of weeks ago when it was around 65%. Some top business leaders and Wall Street investors are also unwilling to say the danger is past. The influential Jamie Dimon of JPMorgan Chase said on Thursday that he would not take the risk of recession off the table at this point. Famed investment manager Stephen Cohen, also the owner of Major League Baseball's New York Mets, put the odds of recession at 45%. I think we're going to have a significant slowing growth, he said at investors' conference in New York. The view on Main Street appears to be less worried, though. Searches for the word recession on Google had jumped to a 3-year high in March and April, only to fall off sharply since the Trump White House started to roll back tariffs. The number of searches has returned close to the low levels that prevailed before the trade wars started. And optimism is back on the move. Remember, the VIX is down to 17. The fear of greed index, the greed part of it, is back up again. We're in a bull market right now. Believe me, the optimism is back, and it will impact by the middle of the third quarter. Going into the fourth quarter is the golden age. That's just my opinion. It's just the way I feel. Okay, so don't forget to come back at 7:45 tonight, California time, to see Brian White. Brian White again in the morning, and then 2 programs, of course, the Monday morning program tomorrow night on Sunday, and then something. Oh, yeah, what am I doing tomorrow night? I am going to do the Cern Basher story, the bio, as one thing. Instead of 3, part 1, part 2, part 3, we've put it all together. If you want to watch the Cern Basher story, we're going to put it up there, and you can watch it all in one swell swoop. That's all I've got for you right now. It has been great. Oh, wait a minute. What about last night? Last night, Larry Goldberg and I, that been Friday night, Larry Goldberg and I had a great conversation. You should definitely watch that. I will put that post right up there. Oh, and then, oh yeah, you actually need to watch both halves. You need to watch Larry Goldberg and I. I'll put that card. And then also right after that, Brian Wang and I had another phenomenal discussion about some of the same information there on Friday night, but done from a completely different way. If you watch those two together, I think you'll find it extremely useful. I'll put both cards up. It's been great talking to you.